The exact same investing strategy that built your 7-figure retirement account could be the very thing that destroys it. The rules of wealth completely flip the minute you stop working. If the market takes a hit right when you start pulling money out, staying in that aggressive 401k strategy can turn a temporary dip into a permanent loss, meaning you could run out of money entirely. Today, we're revealing exactly what this trap is, why it catches so many smart savers off guard, and how to fix your investments right now so you can actually enjoy your wealth without the fear of losing it all. Welcome to the Ironwood Podcast. I'm Darren Hesselink, and this is Alex Pars. Let's get into it. So let's talk about what happens when people have been investing their entire basically working career. They're 30, 40 years down the line. They've been investing a certain way that's built up this huge nest egg for them. Maybe it's a million, couple million, million and a half, whatever that may be. And then natural instinct is just to say, look, I've done this correctly. I know what I'm doing. I'm just going to keep doing exactly what I've been doing as I start to retire. Why is that such a risk, Alex?
So the primary problem is income. I mean, that's one thing you didn't have when you were working, that you suddenly are putting a strain on your portfolio when you retire, which is the need to pay your bills. And, very quickly, if a market were to fall and you say, you know what, I got to pay the electric bill, I'm just going to wait until it comes back before I pay that bill, right? That's not how it works, right? Yeah. So if you're overly aggressive, you're going to end up selling shares at the wrong time. So to put that more in technical terms, we're talking about dollar cost averaging, which was your friend for the last 30 years. Every paycheck, you're putting money into your 401k. And if the market goes down, we buy more shares, right? Cool. So it's actually kind of fun when you're working and you're investing and saving to see the market take a dip, because now we get to buy more, right? Yeah. The problem is, once we go to spend money, you have the exact opposite phenomenon, which is if the market goes down and I need cash, I have to sell more shares. And selling at the downtime is what's going to make it more difficult for you to recover when the market comes back, because those shares are gone.
Yeah, for sure. And this is something we do see a lot. We'll have people come in, and I think the primary thing that we see is that they're probably sitting in mostly large cap. They're in growth funds. There's almost zero bonds, and they're not really diversified in any way. And they're listening to people like Dave Ramsey or other gurus who are telling them, oh, you're going to make 12% per year, so why don't you just take out this huge income? And so they leave all their investments into stock. They transition to retirement, and you're taking this huge portfolio and basically, really taking it to the casino at that point. You're taking so much more risk the day that you retire, and we do see it all the time. This is not an unusual thing for us to see when someone walks in the door.
Absolutely. And everything's fine until suddenly it isn't. Okay. And I'm not saying this is going to happen again, but it probably will. We use the example of the '08 crisis. We had the S&P 500 largest stocks in the U.S., drop by 59% from peak to trough. Okay. So now let's use an example. We've got $1 million, and just for fun, we're taking $40,000 out per year. That should be very sustainable, right? Well, presto, $1 million turns into $410,000 between October of '07 and March of '09. And now we take $40,000 out, we're down to $370,000. How long do you think that $370,000 is going to last now that we're taking $40,000 a year out of it? We're still taking $40,000.
Yeah, that's not going to last long. What, like 10 years, maybe 7 years? It's going to be tough.
Somewhere in that neighborhood. Yeah. So you need to be able to weather those storms. You need to come up with a shift in your strategy from just building the pile to protecting the pile and making sure that you don't run out of money and you don't have to go back to work. Because the last thing we want to see is someone who's been retired 10 years suddenly realize they don't have enough money because of a market dip.
Yeah, for sure. But I got to play devil's advocate, though, because I know what people are going to say. They're going to say, oh, well, they'll look at the last 10 years. It's been so great. Like, I'm unstoppable. I'm never going to make a mistake like that. And when I see that's like that red flag where people get into this confirmation bias that what they're doing is going to continue to work for basically where they think it's going to continue to work because it has worked for a certain amount of time. But you can't rely on that.
Right. And this reminds me of a story. I was talking to a friend of mine at the gym, and he's younger. And we were talking about AI and how things have gone just through the roof. And he's like, AI is the future. There is no end to this, and it's going to be great. And I was like, well, what about the dot-com bubble? And he's like, what? What's that? And I was telling him, I was like, well, look it up. But basically, it was a scenario where, internet computers suddenly were going to make everyone more productive, and, people were going to lose their jobs because there's so much more productivity. And doesn't that sound familiar? But that was the future, so there's no way these companies can go down. Let's throw, that example in there. We'll use the NASDAQ this time during the dot-com bubble. And I've actually got some numbers here. If you started in January of 2000 with $1 million, again, we're taking $40,000 out a year. The first year, the NASDAQ lost just under 37%. So down to $606,000 after we take our money out. That $606,000 dropped another 33% almost the following year, 2001, and then we take $40,000 out, we're down to 381. And then a third year in a row, 2002, we lost 37% in the NASDAQ. That's approximately a 70% drop over those 3-year period. And by the end of the third year, there's only $213,000 left. Now, just for fun, I threw in the next year, which was a great year, 49%. Right? Which that's going to make everything up. But no, we only have $213,000 to grow now. So after a 50% growth, minus $40,000, we're still down to just under $260,000, 4 years into this person's hypothetical retirement. What do you think happens next?
Yeah, it's not going to last long. And then we're coming right back into another sequence of terrible returns. Yeah.
Yeah. The NASDAQ in this case took almost 15 years to recover. Okay, so that's pretty significant length of time if you have all your eggs in one basket.
Well, the one thing I'll say is but that was 25 years ago, Alex. That can't happen today. Things are totally different. It's never going to happen again the same way. Never.
Right, not exactly the same way, but let's look at the players back in 2000. So these were the stocks that were doing really, really well. And then suddenly the NASDAQ loses 30 or 70%. Tell me if you've heard of these guys. Apple, Adobe, SanDisk, NVIDIA. It's the same players. And it's the same concept of new, great productivity improving technology suddenly coming in. Everything's going to be printing money. Maybe it will this time. But I can't say it's completely different.
No, I completely agree. And it does come back to this idea that you're going to have to segment your assets and come up with a different way to approach this. So what would you give as advice to someone who's sitting in that scenario and they go, holy crap, I am super exposed to this. What am I supposed to do?
Well, what part of that is a lot of people don't know they're super exposed to one sector because they haven't looked at the cap weighting of their portfolio. Earlier, you mentioned that people are primarily going to be in large caps, which makes sense. It's been one of the best performers for the last 10 years or so. So even if you had your portfolio completely diversified among different sectors in the stock market, your tech sector has wildly outperformed the rest and suddenly is a much bigger piece. Right now, it's about 40% of the S&P 500 is the top 10 stocks, and those are primarily tech stocks. So even if you think you're diversified, you're probably very heavy into this. And guess what? Same story in 1999. There's no difference there. Everyone thought they were diversified. Turns out they were all in growth. So you need to look at your investments. You need to look at the underlying holdings. You need to understand what you're invested in and make sure you don't have all your eggs in one basket. Quick way to do that, just jump on something like Yahoo Finance, click on holdings, type in the ticker of whatever you have, and look at the top 10. I would guess you're going to be pretty surprised when you see the same roughly 8 to 10 names pop up over and over and over.
It's going to be a little eye-opening once you actually see that because you'll realize how exposed a lot of people truly are to this kind of risk. And who knows what's going to happen in the future? We don't. No one does. We can play averages all day long. We can think about 10 years away, 5 years away, but tomorrow, I don't have a magic button for that. I don't have a crystal ball.
Right, and that's why it's important who we're talking to here. because we're not talking to the 20-year-old, we're not talking to the 30-year-old. We're talking to the people who are about to retire, already retired, and can't see their portfolio take a huge hit, because they were blindsided by the next crisis.
Yeah, 100%. And if you want to talk to a team about your exposure to this risk, head to ironwoodfinancial.com and click Talk to a Fiduciary. And while we've just covered while leaving your portfolio in 100% stocks can turn a temporary market dip into a permanent loss, this all changes the moment you start spending your own money. You need to shift from growing the pile to a distribution strategy. If you don't structure those actual withdrawals correctly, you're still at a massive risk of running out of money in retirement. So check out this video where Alex and I walk you through the most effective way we have found to structure your portfolio for income in retirement.